Okay, thank you, Gavin, for joining us today for the Outside podcast.
Thank you for having me.
Yeah, so I thought we could just kind of start off with like an article that I came across this morning, very relevant to our discussion today. Basically, the Straits Times reported that I think another two more SGX companies have said that they're looking to delist from the Singapore Exchange. Just to recap, like last year, I think there were a total of 17 delistings. Versus just 4 new IPOs, which I think was the lowest, if I'm not wrong, like record low for the SGX. I mean, I don't know what some of your thoughts are on that particular development, because I mean, the liquidity on SGX is actually pretty bleak. And as much as there have been a lot of discussions and conversations about how we can revive the exchange and local listings market, I think most of the people that I speak to are generally quite cynical about the exit market and exit options, especially with regards to IPOs. I mean, this must have been something you've been following for a long time, but just would love to hear some of your thoughts about it.
Yeah, thanks for the topical question. It is, in fact, something that we think about quite a bit because listing opportunities on public exchanges often hailed as the most direct path for exits for VC-backed companies, at least for very big outcomes. And so when IPO markets are less active, then I think that can also potentially impact the expected return profile for private investors like myself. So it is a question that is important and topical. In the long run, I think that the SGX has a potential to be a very exciting exchange for regional listings in Southeast Asia. I think it's well positioned because Singapore is the capital markets hub for at least private financing activity. But historically, the track record for public listings and then delistings, as you mentioned, has had some fits and starts. Right?
Yeah.
I think if I take a macro perspective on what makes an exchange very successful, we have to look naturally at the US, followed by other markets outside the US and Europe, like London or Frankfurt historically, that have had depth of liquidity and listings in those regional markets. And then over the last 20 years, Hong Kong, representing, of course, Chinese assets and companies wanting to tap into US dollar or Hong Kong dollar pegged to US dollar trading activity post-listing. And if I think about what those types of exchanges have that some of the regional bourses like SGX here in Southeast Asia perhaps are still aspiring to achieve, it comes down to heavy institutional investor support and an ecosystem of banks serving those asset management funds that can underwrite and underpin large listings, and that I think provides a positive tailwind and a positive cycle where more companies that have high potentials to become multi-decacorn market cap assets choose through self-selection to go to those markets to list. And once you have that, then you have the retail trading activity and everything that follows, the analyst coverage, the secondary listing activity, the derivatives activity that I think it feeds upon itself in a positive way. So if I think about smaller exchanges in regional markets, including in Southeast Asia, and SGX is an example of that, I think some of that asset management and institutional support is not as deep as it could be. So if you want,
just keeping with that line of thought, right? Like there have been some suggestions about how we can revive the SGX, and you mentioned institutional investors. People have been saying like, you know what, GIC and Temasek, like they should be the ones putting in more money to kind of boost the liquidity, because there's a bit of this chicken and egg kind of situation. I mean, there are also some counter kind of opinions, like maybe this is not going to work. Like, do you think this is going to work at all? Is that even a good idea to do that? I know the minister has come out to say like, no, we shouldn't be putting GIC money into the SGX exchange, which I'm sure to investors has been a bit of a disappointment. But I'm sure there must be a whole range of different solutions that we can have. But I don't know what some of your thoughts are in terms of like potential solutions.
Yeah, so I'll caveat the following by saying that I think very smart people have been looking at this question for a lot longer than I have, and I'm not so much of an expert on the public markets since I spend more time in the private markets. But I do think that some of the conditions that we see in the private markets, where there is strong and buoyant private capital, both in venture and in private equity, to support early stage companies, shows that it can be done. where deep pools of capital in the public markets can also rise to the occasion and support companies here in Singapore and elsewhere. And I think there are signs of all of that. I think the fact that we have a conversation where deep pools of government and state funds, such as what you mentioned, are being discussed as underpinning liquidity pools for listings here, I think it's a good sign. As to how effective that might be versus other strategies, I would say that when government funding comes in, it can have the positive potential effects of drawing in other sources of capital, because it in effect creates a deeper pool and shows a sign of support and perhaps a proxy for safety and quality. On the other hand, an over-dependence on government and state funds can potentially also crowd out the private sector and public institutional and pension funds that we see in other markets, playing a very big and active role and much larger than government institutions in other countries like the US. So I think it's a multifaceted approach. In the long run, I think when we're talking about private capital and capital markets, it needs to be sustained ultimately by private capital, as opposed to being, I think, wholly dependent or heavily dependent on state capital. But there's a role clearly for all the above to play.
But let's say if the SGX doesn't manage to kind of revive the listings market in the near to medium term, what do you think this is going to happen to investors like yourself and the entire private capital ecosystem? Because I'm sure you must be having these sort of conversations with your LPs, because ultimately you also want to return capital back to your investors, right? Is this a serious kind of conversation between you and investors? And even what does this mean even for your conversations with your portfolio companies when it comes to exits?
Yeah, no, so it's a great question, and many pieces to that. So let me try and break it down into three pieces. I think one is exits in general and planning for a listing. I think two is where else in the world other than perhaps Southeast Asia that can be the case, so those venues. And three, maybe I'll address specifically, if the SGX does or does not do a few things to kind of make the local listing market more buoyant. So just starting with the first bit, which is how we plan for and communicate with our entrepreneurs. As VCs, we are minority investors. Our model at Altara Ventures is to be a significant minority investor and a lead investor at the Series A and Series B. So generally speaking, for companies that are pre-growth stage, we tend to own maybe 20% of the company. And we expect to hold double digits to our point of exit in the future. So when we work backwards and think about the return potential that we want to deliver to our LPs and investors, we need to have a candid conversation also with the entrepreneurs that we invest in on those expectations and that time horizon. Now, public listings tend to be the biggest, largest, and most exciting type of exit, but it is only a chapter, I think, in a company's life cycle. In fact, it's actually the beginning of a very long future for companies that now have access to permanent public capital versus having to raise on a regular basis in order to stay alive in the private markets. So it may be when we exit an IPO as a VC, but it's not when I think the chapter by any means closes for the company. So when we speak to founders on sort of building for that kind of exit, it has to be in the context of what this overarching strategy is to build a sustainable and large business in their field of choice. But we do speak to them and we'll say, if a company is lucky enough and where we are lucky enough to invest in an asset that has that potential, where they can, show a path of profitability, show top line growth, as well as meet the corporate governance and compliance standards to be a public company, which is both a market as well as a DNA of the founding team question, right? And if those conditions are met, plus the macro environment is positive, and right now we're not quite in that part of the cycle, then I think planning ahead is really important. So we'll talk to entrepreneurs and we'll say, as you think about the next 2 or 3 rounds of financing, where should they come from? If the plan is to list in the US, for example, which would be a very, very large outcome kind of potential, then having growth equity investors or late stage crossover investors from that region will help a lot at the Series D. Conversely, if a listing might be more regional in nature, like say Hong Kong, because maybe the company has commercial reasons to tap into more of a China-centric strategy for expansion, then again, for the Series C or Series D, it might be good to have institutional investor support from for example, Hong Kong investors or in some cases, Chinese investors. I think outside of those two very deep pools, the preparation for the path to IPO as a VC on the board of a company really becomes a bit more tied to where the commercial realities are of the company. So if the business has ties to Japan or Korea, then those are developed market with real potential for exit, but they have their own listing requirements and domicile requirements as well. Here in Southeast Asia, the natural choices to date have been SGX for reasons that we have discussed and we'll talk about, followed by Indonesia, where we've seen a number of companies both list and then in some cases delist, followed by Thailand and Malaysia, but typically where they tend to be more SME driven for local single market types of businesses, less appropriate perhaps for a VC type tech exit. So I think having that candid conversation and then at the end of it, maybe concluding that an IPO might not be the best path, right? That's a perfectly valid conclusion as well. And then planning for another type of exit, perhaps via M&A or trade sale or private equity exit for a company that's standalone and profitable. That then ensues from that. So that's sort of my perspective on that kind of the first piece of the decision. The second bit on where we touched on this a little bit. I think Singapore is very well positioned as we've discussed for public market activity because of the rule of law, the corporate governance, the depth of private market activity that it feeds the pipeline. But that hasn't yet converted really into big tech IPOs, as we've observed. And so the kinds of companies that have historically done very well and fed into the SGX's traditional strengths have been dividend stocks, and particularly banks and financial institutions, as well as REITs, where your likes of CapitaLand and Keppel and others generally are heavily regulated, where they have to distribute like 90% of profits.
They're mostly dividend plays, essentially.
They're dividend plays.
Very defensive kind of plays rather than high risk.
Right, and tax advantaged, right, because of their REIT status. So if you look at those two pools, financial institutions that are kicking off a dividend and a coupon, and then REITs that exist to distribute dividend yield, you end up with a market that has trained investors to be quite conservative. Those are the options available. And I would say that for a period of time, Singapore also offered an interesting market for derivatives. But I think that's less of a focus for the first initial offering of a private company. I think that derivatives trading activity comes when you have a deep market of already publicly traded equities, right? Or debt. Now, with regards to then the third bit of my comments here on what the SGX might or might not do, and again, not be an expert on public markets, I do think that what makes Singapore very unique and the Singapore capital markets really unique is reputation. Reputation for strong corporate governance, for transparency, for ACRA, doing its job extremely well, and I think that is why Singapore is chosen as the de facto top co-location to raise money from anywhere in the world, including and most predominantly in US dollar. So for thinking some food for thought for the future would be, if we want to make the Singapore market and SGX more buoyant, it comes down to willingness to take risk, right? In what is allowed to list from a compliance, profitability record perspective. MAS has their perspective on that. And then also from an investor perspective for those institutional funds or pockets of state money that are willing to back companies that don't look like what I described is already tried and true here. Yeah. And I think if you have that, then the retail support to take a position on something that isn't a defensive dividend-bearing investment strategy will follow. And I think there's been a lot of discussion as to how to get there, but the jury's still out on how fast.
Which I think is also, to me, I think the SGX is also in a kind of very pivotal point as well. I think you touched on a really interesting point about risk, right? Everyone seems to have this idea, which I guess must be true to some extent, about the level of risk aversion that we have as an ecosystem. And this goes beyond the retail level, like even to an institutional level, right? How risk-taking are we as investors? How risk-taking is the ecosystem? Our talent even in terms of really taking risks. And do we as a market penalize people for really taking kind of out there, otherworldly, like really out there kind of risk? Is something I don't think we've managed to really encourage or even resolve. And ultimately, if we are still comparing ourselves to the US, right? And I guess everybody wants to compare themselves to the US from a market perspective, from a depth perspective, from a liquidity perspective, then that's what you actually need. And I don't know if there are any real immediate solutions without having to take a really bold step forward. And I think that's what I think is going to make the job of the SGX actually way more difficult this time. Because I mean, my concern is that if they're not able to resolve this anytime soon, then we're going to be losing a lot of great tech companies to overseas markets, right? I just did a conversation with like Celestial. He's moving to the US, this is deep tech company that's coming from Singapore, and the concern is that, if we don't manage to fix some of these like underlying issues, we're going to be losing there's going to be a brain drain. I mean, I don't know if that resonates with you at all, or if that's something that you've noticed, but that's something that, I've kind of always kind of thought about.
No, it's a sobering thought and an important point. Being a VC investor where our job is to take calculated risk early on, I think we probably skew a little bit more on the optimistic side. We are seeing more talent from overseas markets come back to Southeast Asia. So, Singaporeans with roots globally that have built businesses or invested in deeper markets, trying to come back and contribute and build something meaningful here. I think if you look at many of the founders of the first wave of IPOs and some SPACs that have gone out in Singapore and also Indonesia in the last 3 or 4 years, I think many of them fit that description where they were talent that chose to build a business here and hired skilled labor and engineers and technical talent from different parts of the world and imported where necessary, and also cultivated and hired and attracted kind of forward-thinking folks that are willing to take sort of those kinds of risks in their careers to build something meaningful. But in terms of retention, in terms of where things are going forward, as you mentioned, it is it's a delicate question as to can this ecosystem that's still very early sustain that. So I think on the in the plus column, you see companies now having a history of call it professional middle management that are not a founder per se, but are coming out and starting new businesses. So they've seen what the path can look like all the way to closing the loop, either with an IPO, more successful, less successful, persistent in terms of the company surviving as a public company or being taken private aside. I think that journey has brought confidence to a new class of entrepreneurs that have come out post 2022, 23. And on the, maybe on the question mark side, it's, to your observation, if you are, an engineer or a software developer or a founder in Southeast Asia, and you're building something where the commercial market in our immediate vicinity is perhaps not as large as a more developed Western market, even though there's more competition there. I think a natural question would be, do I need to make that move, make that jump sooner rather than later? I think companies that are built for the Southeast Asia consumer, or that are in relatively regulated spaces that have kind of local conditions such as education or healthcare, will probably tend to think more about staying and building in this region just by nature of business model and then hiring as such. I think companies that are maybe more global by necessity, enterprise software, deep tech, space tech, and I think businesses maybe in life sciences as a distinct from healthcare services would need to think about making that jump into deep reimbursement-driven markets or deep markets where you have an established pool of customers and talent, whereas it might be harder to find that in Southeast Asia. And so I think if I kind of just maybe reflect a little bit on where things might go, there is a state of the world where Singapore, with regards to talent, could look like an Israel, right? Where the local listing market is not particularly deep, but the talent market for entrepreneurs and for engineers.
But the exit the number of exits that Israel have is nowhere compared to Singapore, though. I mean, I think they are, in terms of IPOs, after US and China, they're number 3.
That's right. And those IPOs are not in Israel. Those IPOs are global IPOs and heavily
a ton of M&As too.
Heavily US and M&A. And so my comment was more about, might that be a model where you have maybe companies that choose not to list so much locally or regionally, or they might use the SGX and other regional exchanges as a secondary listing venue, but can still be Singaporean, Southeast Asia businesses in terms of IP and talent going after global opportunities. And I think that has been more of the Israel model as it pertains to deep tech and enterprise.
But I think the difference also for Israel is that you see a lot of the tech that comes out of Israel is actually made for the US or a global market, which is not really the same as the technology companies that have come out, at least historically, for Southeast Asia. A lot of them have kind of used Southeast Asia as that, okay, this is our TAM, this, Southeast Asia, 600 million people, right? Of course, I think now you're beginning to see a couple of these companies, especially if you start moving towards the more deep tech type technologies that are looking to, serve a more global kind of audience. I mean, I don't know, maybe as you say, maybe that's kind of the way forward, right? Like we need entrepreneurs that kind of think as the world as their market as opposed to just Southeast Asia as their market. Which I think to the second point that I have is I think in the last like 3-4 years, I think there's been kind of very serious, people are kind of relooking at what is the real TAM of Southeast Asia, right? I'm sure that's something that you guys have been looking at as well. I mean, I don't know for you guys, like, have you had to kind of revise your, idea of actually how big the TAM is for Southeast Asia? Because everyone says it's 280 is Indonesia, 600 million people in Southeast Asia, but maybe only 10% of it is what you can truly monetize here. I mean, I don't know what some of your thoughts are on that.
Yeah, no, TAM is a critical question when it comes to the ceiling for opportunities, right? Regionally versus globally. I think that when we look at emerging markets, China, India, right, as models, holding the US aside, which is a developed and mature market. So following in the footsteps of other emerging economies that have created a technology ecosystem and applying perhaps some of those parallels to Southeast Asia, I think that generally speaking, it's first consumer driven. So it's B2C type business models, as we've seen here in e-commerce and ride hailing. And then it moves into B2B2C. Call it financial services for consumers that then become financial services embedded in some of these platforms, or ultimately, eventually, perhaps serving financial institutions. And then as a tech economy matures, you see more B2B, like enterprise software, right? And, if you take an example of like Alibaba, they started with truly e-com. They moved into logistics to fulfill all the e-commerce activity. They obviously went to payments in a major way and then into lending. And then now they have Alibaba Cloud, right? Trying to challenge Amazon and web services and cloud hosting. So that evolution is, I think, quite natural if you think about it. And the companies that then compete and contest against regional and then global competition tends to follow that. Southeast Asia's first wave, to kind of follow on your comment about what types of companies come out of our region, have also fit that arc. It's been B2C and then B2B2C, and now starting to become more B2B, but early. So I would reserve the scorecard on how well the B2B and hence the global market opportunity for some of these companies are for maybe another 2 to 3 years as the market matures. Now, with regards to, I think the, call it general observation of being a global business versus a regional business, my sense is that the technical talent to build really deep tech and IP-driven businesses is not as deep here as it could be. And we used Israel as an example. That is an economy very much driven for B2B, and as you observed, build for US listing, US M&A. Southeast Asia hasn't reached that point. And I think it may be partly because of this TAM question that you brought up. I think if you're in Israel, you have a natural TAM, which is perhaps the local market and then the West. In Southeast Asia and for Singapore topco businesses, we see this number of, you said 600 million. I think the last we did the count, it was 671 million of the, the ASEAN 6, right? And those 6 economies. Of course, ASEAN is larger than 6 countries, but that is generally where we focus our energy and effort. And you're right. While the regional TAM is as such, it actually is more fragmented into geographic pockets as well as socioeconomic pockets. So to again draw another parallel from another emerging market, India has north of 1.5 billion people, but it's often cited that really the TAM for truly kind of consumer, call it middle class plus, would be closer to 200 million. So 10 to 20%.
Which is still very sizable.
Which is very sizable. Now, if you apply that to Southeast Asia, now the headline numbers are smaller, 600 something, but also the fragmentation by country and GDP per capita is quite different, right? So the top 10% of consumer discretionary spend in Indonesia or Vietnam will look quite different than the top 40% in Singapore, right? That those thresholds are quite different. But I do believe that Southeast Asian founders from early on, particularly Singaporean founders, have a mindset to expand beyond one country because they have to. And that has been the case even for traditional businesses, right? So I think that DNA and mindset is good in terms of tapping into a larger TAM. The second is Southeast Asia is not so much beholden to the sort of legacy of the desktop web generation, right? As we all know, as a region, we've leapfrogged into mobile, into crypto, into Web3, into AI very fast. And that is because of urbanization, digitization, a young and growing middle class that I think is not perhaps affected by the same population demographic shape as other countries. I mean, we often quoted China is graying and aging faster than they are getting wealthy, right? So there's that kind of middle income gap that is a concern, right, for very large emerging economies that have not yet made it to the promised land of U.S. capital markets activity and general wealth. But these are still great outcomes for regional economies. I mean, what China's been able to achieve in a generation is incredible. So when I think about Southeast Asia and where we can go, I think ASEAN is a more common market, although it's not set up in the same way as the EU and single currency area, but one where you have tax treaties in place, where you have freedom of movement of capital and increasingly movement of talent, where you have a middle class that continues to grow from strength to strength, where you have capital markets activity that generates public trading that lionizes or casts a positive light on risk, as we talked about earlier. I think these are all the tailwinds that are emerging that will help with the growth of TAM for tech businesses.
You're so positive.
I have to believe it.
Okay, you do have a couple of like B2C or B2B2C type companies within your portfolio, right?
Yep.
Rising middle class in Southeast Asia. I mean, is it still a rising middle class in Southeast Asia? And, I'm sure you're in very active conversations with particularly your B2C or B2B2C kind of portfolio companies, right? And we're also in an environment like a generally globally inflationary kind of environment. How do you see that impacting, margins, bottom lines, how they're adjusting their pricing strategy in Southeast Asia as a whole?
Yeah, no, that's a great question. And it's one that we've been discussing in a few different contexts. I'll highlight two. One is in financial services, so consumer digital bank in our portfolio called Tonic. The other is actually a healthcare company that produces a diagnostic test for cancer treatment. And they are distributed both regionally and then globally. So they have to think about some of these pricing considerations. I think a good example within financial services, as I alluded to, Tonic is a digital bank. And just to, in a sentence, describe what they do, they are the first fully licensed digital bank in the Philippines. They take retail deposits and then they produce loans. And those loans are taken up by primarily consumers in exchange for being able to buy a house. So they do secured credit as well as cash loans for discretionary purchases. And they promote on digital media. They compete in a market where interest rates are competitive with traditional banks and other retail banks. And they have a brand and they have a sort of a consumer-facing presence. So in this environment, in the last few years, interest rates have been high. And the question is, where are they going? I think consensus view is they're coming down. But what we've heard from most recent policy rhetoric out of the US is that we'll be in a more permissive monetary environment, perhaps, and probably a more inflationary one given the prospect of tariffs by the Trump administration.
And Trump coming in now, which I think is going to push things even further.
I think so. And in an environment where inflation expectations are expected to persist a bit longer, then I think interest rates may stay higher than perhaps what might have been predicted 6 months ago when rates were coming down aggressively. So if you are a consumer digital bank or a financial service provider in the business of extending credit, then generally speaking, high interest rates are pretty good for business.
Mm.
Banks make money on the spread between their use of funds and their cost of capital.
Mhm.
And while both trend up and down together,
Mhm.
meaning in a higher interest rate cycle, you can charge more on loans, but your cost of capital is also higher because depositors expect a higher yield. Overall, during sort of heightened parts of that credit cycle, higher cost of funds, higher interest rates tends to lead to generally higher performance. Now,
But Southeast Asian consumers, I would think, are probably more price sensitive today than before, isn't it?
it's true. And I
Yeah.
think that's where being in line with competition
Yeah.
and competing on not just price, but on brand, on quality of service, and other elements of providing consumer financial services is very important. Reliability, reputation. But your point is correct, because at the end of the day, probably the most important factor in anyone taking a loan is how much you're going to pay for it, right? It's the price of funds. And one thing that we've noticed in kind of the consumer mindset in this region is the relative change in interest rates is not as pronounced as perhaps in Western markets where interest rates were low for a very long period of time. So I'm not talking about Singapore, where interest rates are still in a pretty low environment. But if you look at Vietnam or Indonesia, a secured mortgage, consumer mortgage, has always been double digits, even when interest rates globally and when federal funds was close to zero. And so when you go from I think it's supply and demand of capital. So, that's one.
Wow.
Two, I think it's maybe credit quality, or three, it's, it could be regulations. But if you look at most of the ASEAN economies, you see high single digit deposit rates and high teens secured lending rates, even in low interest rate environments.
Wow.
And so when you go from 15 to 19%, yes, it hurts. And it absolutely is a reason for someone to consider whether they can take as big a loan out. But the impact is a lot less than going from 1% to 5% in a market like the US. So indeed, it is true that the Southeast Asia consumer financial services is probably more price sensitive now than in the past, partly because of economic conditions, belt tightening, and so on and so forth. But generally speaking, I think the countervailing factors are, as I described, the comparison to history is perhaps a little bit more favorable in this environment for even interest rates staying higher longer. And two, the core growth, meaning the rate of return on how that capital can be deployed, will be a lot higher than single digits if we agree with the narrative that Southeast Asia has long-term tailwinds that are growing faster than the developed world. So I think, hence, inflation, interest rates, some of these geopolitical and macroeconomic considerations, they can be quite good for banks and financial institutions, as well as consumer credit, digital banks. But of course, at the end of the day, it needs to be balanced against the realities of competition. I'll give you another example in the healthcare space. We have a company in our portfolio called Cayenne Technologies. They're a Singapore-based company, NUS IP, that we helped to spin out, combine with UCLA IP, and then develop a business around that is fully HSA approved now. So they are being used in the public hospitals in Singapore for cancer diagnostics testing and personalized medicine approaches towards treating cancer patients. And then they're being sold on an out-of-pocket basis to private hospitals in Southeast Asia. They have just completed the first phase of entering the US market with a partner in the US, just given the requirements can be quite high to enter the US. So in their 3.5 years of activity in as a startup, they started in Singapore, got regulated in Singapore, sold a regulated cancer test in Singapore, and then used that validation to expand in the region, starting with Indonesian private hospitals, Thai, and now Hong Kong, and then used that tailwind to then expand into the US, where ultimately that's a much deeper reimbursement market, right? Where it's not so much out of pocket, but really driven by public and private insurance. So that will be the arc of this business. Very different than perhaps a digital bank, but it still comes down to this idea of pricing. What is the appropriate price? So what Cayenne has chosen to do is price their tests in terms of the out of pocket to consumers, patients, at $4,000 a test, equally in all markets. And in the US, they have consulted various analysts to set up a reimbursement crosswalk code, which is what Medicare and Medicaid in the US will pay for a similar type test that's already in market. And it is also set at around $3,000 to $4,000 a test. So in this situation, what the company has chosen to do is actually not price based on local market ability to pay on a GDP per capita basis,
Mm.
but price on a universal basis, at least for now, holding that price point at something that can be substantiated both in tier one, call it developed markets like Singapore and the US, but then also within the ability and willingness to pay for private patients in other parts of Southeast Asia. Now that pricing model may change over time, but they made a conscious choice to take that approach. And so far, the actual patient volume from Indonesia has actually started to challenge, if not exceed, the patient volume in Singapore, even though they started here. So I think that speaks a little bit towards, call it, the ability for a rising middle class to be able to afford and pay for products and services that they see true value in, even if it's out of pocket in healthcare. I think it also speaks to certain categories of products that price sensitivity is going to be a lot less. Right? If you think about e-commerce, price comparison is very easy. When you think about healthcare or education, I think here, you get what you pay for, right? And to some degree, there's a lot less price.
I mean, the difference also is they have an IP. So I guess if you have IP, you are able to kind of command, premium, so to speak. A bit more defensive in that sense when it comes to price, as opposed to, e-commerce, right? You can compare endlessly to any kind of platform that you want, and these days there are so many ways that you can compare a similar type product with a similar type offering. So that would make sense, I guess.
Yes, indeed.
Yeah.
So, I think when we, on this topic of IP, and which also segues a bit to what we were talking about earlier on B2B and enterprise, deep tech, space tech, forward technology and advanced technology areas. It's not one-to-one. It's not like every B2B company has IP, and not every IP company is a B2B company or one that aspires to launch satellites, but they tend to correlate. And I think in Southeast Asia, the first wave of companies that we've seen become regional success stories, your Shopees and your Grabs, they have a lot of process IP, they have trademarks and brands, but at the core, they're operational and execution-driven businesses that are tech-enabled services companies, right? Providing great products and services at scale to the regional population, but not perhaps from the perspective of truly groundbreaking technology and IP. I think that that's very natural, as we talked about previously on the evolution of business models from consumer to enterprise and deeper tech in markets like China or India. I think Singapore is actually very well placed, and Southeast Asia as an extension of that for certain sort of more forward-thinking technologies, right? I think Singapore has always been an advanced manufacturing hub. Some of our earliest unicorns were companies like Creative Technologies in the 90s, where we had, IP-driven speakers, right? And sound technology that became ubiquitous with kind of high-quality PC speakers in the West. If you think, into the 90s and 2000s, precision engineering, contract manufacturing at a very high level and quality. And this underpins, regional champions like, Sunningdale today that are here in Singapore. And when we think about the future, whether it is an aerospace where, Singapore is a very deep market for aircraft leasing, right? It's where the financing for all of that already takes place for carriers. I think it's an extension to think of, for these types of opportunities where the aircraft of the future, where the spacecraft of the future can come from. And I think Singapore is quite well placed from a regulatory as well as from a historical perspective to be able to launch these kinds of businesses that ultimately will then look to the West, right? Or to China for commercial opportunity. Another area that's maybe less about historical kind of advanced manufacturing or the DNA of that tilt of our economy might be around the regulatory and compliance environment. So we tapped a little bit into this when we talked about the MAS and ACRA previously, creating positive environment for startups. I think that under Trump 2.0, what we will see is looser regulation on financial institutions. So rolling back some of the capital adequacy ratios that the Biden administration put in, the Dodd-Frank Act in the US also, I think will get rolled back to some degree. And then clearly also he's made a lot of...
arguably didn't really work out that well. I mean...
I think that the record when it comes to regulating banks is mixed. Whether it's Glass-Steagall separating investment in commercial banks, Graham Leach Bliley in the 90s that modernized and allowed universal banks, right, to come about where they owned brokerage and distribution as well as lending and corporate banking under the same roof. to Dodd-Frank, right, to improve, call it the capital adequacy ratios and requiring banks to be safer, and all of that evolution pings back and forth based on macroeconomics and politics. And the US has seen that for 100 years. I think Southeast Asia, outside the MAS, doesn't try so hard. I mean, frankly, I think the MAS tries very hard and has struck a middle ground for where we are today. But my comment is more around what the perception is of safety and quality.
Yeah.
And when we think about, Trump and some of the crypto market resurgence, right? And we have a Trump coin, right? We have, Bitcoin back up at over 100,000. I mean,
his entire cabinet is like VC people.
There's some of that. Certainly, I think Peter Thiel, first time around, Elon Musk, this time around, I think they have made their presence felt in different ways, right? And that might be feeding into some of the tech industry-driven policies. But back to kind of the regulatory environment and where Singapore might be well placed in the future for things that are IP related, right? I think that regulations around Web3, digital assets. I mean, these are all things that Singapore has written about, the state has a policy on, and I think that brings a lot of comfort potentially to investors globally. So these, I think, are the pockets of where IP can come from that lend themselves well to both the history and then the safe regulatory framework and respected reputation of where Singapore sits today. These are not necessarily the end markets that will be immediately rewarded in the rest of ASEAN. And so I think this might be more of a Singapore-specific comment where, the kind of IP that comes out of an advanced manufacturing pipeline, the kind of corporate governance and rules that enable proliferation of new Web3 technologies, not necessarily crypto per se, but Web3 more broadly. These are things that I think can be Singapore IP that then can be exported to other markets at scale. So when we think about deep tech, and we think about, enterprise software, these are some of the lenses that we apply. And I think that that's also one of the reasons that, Singapore, even though the TAM is small, the opportunity and the prospects can be quite bright.
Yes, this particular post that I saw on LinkedIn recently, actually it was made in reference to the whole eFishery's scandal that came up recently, which I'm sure you've been following. Kind of questioning this whole idea of, for so many years you've talked about like tech-enabled technologies, this label of like we branded eFishery, which was essentially a fish feed company, into a tech company, and that fetched tech valuations when actually if you look at its very core, it's not really a tech company, it's just a very traditional business, right? I do wonder, I mean, I don't know what your thoughts are on this, especially now with like AI, and I think we're going to see another generation of AI-enabled businesses that will, I guess, maybe VCs or the VC industry will try to kind of use that as a way to fetch AI valuations. I mean, do you think that's a fair kind of approach to take, given the direction that we're kind of moving towards?
So if I play back the question, I think it's a fascinating one. It's traditional business techified becomes tech financed business. And then now tech finance business AI-ified can become kind of even more sort of deep tech multiples where, you get an even higher premium on, perhaps, early revenue that tends to be more service driven in truth. It is something that we think about a lot when we look at any of our logistics and supply chain businesses. And broadly, I think, these are all considerations in terms of how much tech goes into a business. But the core question is, why is that important, right? And to a VC, this sort of sheen or veneer of tech becomes exciting and sexy because tech means you have operating leverage. Instead of having to throw more labor at the problem, you can work your AI algorithm 24/7, and you can take cost out and offer a product or a service better, cheaper, and faster than traditional services-based or labor-based approach in the conventional economy. Now, sometimes we can overdo it, right? And see something there that may not be there or may not be there yet. I think in logistics and supply chain, there is absolutely a role for technology, also a role for AI. But for all of that to happen, you need to have high quality, deep sets of data, right? And then you also need to have transparency and accountability around that data. In the case of aqua supply chain, of which eFishery is one example, but there are others in prawns like Aruna, in other areas outside of inputs and feed, so more trading of fish like Delos in Indonesia, and then you have in other categories outside of aqua like chicken and pitik in dairy supply chain. The same considerations apply, which is to what degree can you improve processes to deepen the data set, collect more data, and make it more transparent and accountable with technology, such that you can then layer on all these other value-added services. Yeah, like pricing transparency for bid and ask spreads on trading, for lending, using a tech-driven credit model to lend to your farmer or your fisherman, and then ultimately maybe on price predictions and forward markets in the future, right? These all come from a tech stack that has to be built on a solid foundation of quality data. So we have a company in our portfolio, so I'll give a real-life example. It's a business in the Philippines called Kita, and they are in vegetable supply chain. So when we evaluated the opportunity, we asked the founder, Mark Concio, actually quite extensively on how important technology was to his business. Because at the core, if you look at it, they are competing against traditional vegetable trading companies. The answer he gave, which has actually sort of manifested in a few different ways, is there are a few leverage points in the value chain from farm to table where technology has a differential improvement opportunity. And he identified the trading post, which is the wholesale location where farmers bring their goods to wholesalers that then buy it and then ultimately sell it to hotels, restaurants, cafes, supermarkets. But this midstream piece is where there was the most inefficiency. And hence, the sustained margins being captured by middlemen exceeded 75% of the value capture. So the farmers weren't getting paid as much, and buyers were paying more than perhaps they needed to because of inefficiency in the middle mile. Some of it is physical inefficiency, spoilage, shrinkage, wastage, which happens in aqua, happens in dairy, it definitely happens in fresh vegetables. But some of it is also this point around price transparency and product quality transparency at the point of wholesale trade. So what Kita's unique selling proposition is with technology is to digitize that trading post, putting in scales. So as trucks come in, they're weighed. As produce gets taken off, they're weighed again. The difference is how much, in their case, highland vegetable has been offloaded. And then the pricing and trade between buyers and sellers are put transparently on a digital board. So this isn't AI, right? This is using basic enablement of technology to bring price transparency to the point of sale, where all participants at that particular point of sale can see clearly and where the quality of the data is accountable. And from that, they've captured more of that midstream trade that has enabled them to then capture margin, which is the business model, but then also get into agri-inputs upstream, and then a greater share of downstream distribution. So would AI layered on top of that help? I think so. I mean, there are ways to be more predictive using large language models and all of that data. Is it critical today? I think not as critical as implementing digital transformation, cloud technology. I mean, really the bread and butter to take that middle piece of the supply chain and extend both ways with the use of technology. So that was our thesis. It hasn't been smooth sailing. As with startups, things take longer to get the licenses, to get these trading posts online. But I think the founder's vision and the technology components made it exciting. So if I apply that lens to answer your question in other areas of supply chain, I think the key message is you need to identify it, believe it, and then execution follows. So ideally, those data points line up. But I think forcing it doesn't work. Where, if a business is truly an offline trading business, and what they've put on is a online Excel order form and called it an e-commerce front end for B2B supply chain trade, that is not a tech business. And if a business doesn't have the data and the underpinnings to be able to run models, then they can try and be an AI business, but the time between A and B is going to be beyond the life cycle of the company and our investment horizon. So I think that's hence why it's important for many of these businesses that are perhaps more services centric, and I use logistics and supply chain as an example because they tend to be traditionally quite labor heavy, to be very clear about what that unique selling proposition or competitive advantages in technology.
Okay. Quite a few questions, but the first one, I think, again, going back to, eFishery, and again, you're also quoting kind of a business that's in a really traditional sector, right? I think the eFishery scandal that kind of came out, kind of raised a lot of questions around like DD processes, especially for informal sectors, whether it's in vegetables, whether it's in fish. Like, how did you guys kind of approach that? And I mean, it must have raised a lot of alarm bells even for you, because I'm sure any investor can fall prey to this sort of behavior from founders. Not that I think that all founders do the same
Of course,
thing,
yeah.
but unfortunately it does happen.
Yes, I think in every market there will be examples of misconduct.
Yeah.
I think that it is
I mean, do
really...
you actually go and weigh every single bag of vegetables?
No, I can speak a bit to how we do our diligence,
Yeah.
but I'll start by saying what I see our role is as a lead investor. When we lead at the Series A and B, which is our target zone, we set price and terms and assemble a syndicate,
Yeah.
which involves existing investors as well as new investors. So to some degree, we are, as lead investors at Altara Ventures, responsible for driving the diligence and also responsible for corporate governance on the board of these companies post-close. Whereas a follow investor in the syndicate or a smaller fund that's not pricing or leading may end up being an observer or just getting information rights. But the duty and standard of fiduciary responsibility is not the same as when you sit on the board and when you lead the round. So we take these responsibilities very carefully. As to then what diligence means for us, our process involves in-house as well as outsourced due diligence. And the in-house component is generally more commercial due diligence in nature. So we will look at customers, we'll look at suppliers, we'll call them, we'll speak to management team members, we'll talk to employees present and past, and form a view on whether what is being represented to us is in fact accurate based on our sort of initial assessment. Post term sheet, we will then also engage legal due diligence and financial due diligence to look at the company's legal documents, corporate structure, so that share capital and all of the key elements of ownership are established, or where needed, we can bridge and restructure. And then on the financial due diligence side, we will spot check using local accounting firms in local markets that know how things are done and how books are managed, the management accounts of a company, almost like a mini audit closing. And so those form the sort of final analysis in our investment committee as to whether what is being represented is aligned with what we expect the company to be at today, and hence where it will go in the future. Now, those tasks are not foolproof, right? And I think there is a balance to be struck between counting every single inventory asset and closing expediently in a competitive market while fulfilling our fiduciary responsibility to our investors and, as directors to companies post-close. So I think that one of my learnings since coming back to Southeast Asia is how to ask these questions to get an answer that may not be what the entrepreneur thinks you want to hear and may not be what you want to hear.
You never faced this when you were in the US.
But it's something that you absolutely need to think about and be cognizant about.
Oh.
I absolutely have faced this in other markets. So I don't mean to call this out as a Southeast Asia only consideration. But I will say that in more emerging markets and earlier regions, I think there's maybe a good news bias where founders are newer to managing their boards and their investors. And so maybe a bit more hesitant to share the full unvarnished truth of the good and the bad. Maybe there could be a little bit more of this, okay, I treat my investor syndicate as like another kind of client or customer. So I manage their expectations when I'm selling them shares in exchange for capital, and I manage their expectations when I am providing this view of management accounts and full year performance when they're on my board. In the same way that I need to sell to a customer and account manage a customer. Whereas I think in developed markets, like in the US, you have professional entrepreneurs, right? They see themselves as the 0 to 1 lady or guy, or the 1 to 10 founder, or the 10 to 100. And you see serial entrepreneurs that succeed and fail. When they fail, they get back up and they do it again. When they succeed, they're happy at some point to hand off to professional management and start that next one because their sweet spot is in that range of a company's growth. In Southeast Asia, I think some of the exemplars of businesses that have become large and successful, tech, public, or traditional, have usually been founder-owned and held and controlled all the way through. Whether they're family business-owned conglomerates, or if you look at the first wave of IPOs, it's really the founders that are still generally at the helm of these companies. So I think that mindset is more perhaps like a business owner or of a SME that's growing quickly, as opposed to a serial entrepreneur that's a professional starter and grower of businesses at different phases in the life cycle that then will hand off to professional management. So you see the difference is if the entrepreneur takes it as, this is my company, it's not our company. And hence what the governance means is what I choose to share with the board. And some will be more forthcoming, others might be more guarded. It's not good or bad, it's just sort of more a reflection of, this is how it's always been done. Then you're going to get a certain kind of corporate governance outcome, perhaps, than in a market like in the US where, serial entrepreneurs depend on their reputation. Disclosure is really important. The legal environment, the litigiousness of being able to go after bad acting is far deeper. And the history of that, where investors and entrepreneurs have won court cases against each other to provide guardrails on what is acceptable corporate governance behavior, is all very clear. And so while I've seen, all kinds of different behavior from founders and co-investors in different markets, from my time investing in the US, actively in Europe, and then now Southeast Asia for the last 8 years or so, my perspective is that the earlier a market is, the more some of these wrinkles have to be worked out. And I think shining a light on situations, while they may be unpleasant, like eFishery in the here and now, eFishery is not alone in having these misconduct allegations being bandied about. And I think not being an investor, I can't speak to what really has happened, but I know that there will be a waterfront, right, that is constantly moving back and forth on the quality of corporate governance. And as investors, we need to meet the tide where it's at in our diligence approach and our corporate governance standards, to hold them at a high level. And show that, we can hold ourselves to a standard that at the end of the day benefits everybody.
Okay. I think one last question I have, and this is, I guess it's a two-parter question, is on the investor side and on the entrepreneur side, in the last 8 years that you've been back in Southeast Asia, what do you think have been the major shifts? Like, have you noticed any major shifts on the investor side, and what were the major shifts on the entrepreneur side, like both good and bad, just based on your observations? Because the last 8 years, a lot has happened here.
I'll start with the investors, and I'll maybe answer from a perspective of self-reflection rather than on my peers in the industry, although I imagine some of these might be relevant. I think what has changed positively is that investors have become, I think, more attuned, generally speaking, to Southeast Asia being fragmented. So it's not one big market, but local varieties and flavors become really important and have adapted to that. And I think that's a good thing. And I've learned a lot, and I've made a lot of mistakes along the way to look at businesses with that lens. And with that, to our previous kind of comments, corporate governance, I think, has also gotten better. We hear more, perhaps, of some of the things that hit the press, but that's because I think more people are looking and more people are paying attention. And I think that's a healthy sign. And as investors, our role on the boards of companies and in identifying the next set of founders is to reward companies that want to build big opportunities, but do it in the right way. And I think that there is more sophistication to support all of that. In terms of the bad stuff, right? Or what has changed in
Room
perhaps
for improvement.
Yeah, less I think clear, but I think trending in the right direction as well. In Southeast Asia, I think we've seen capital come in and out from an investor perspective in a fairly call it transactional or knee-jerk way, right? I think during COVID, we saw a lot of crossover investors come in, likes of Tiger Global, SoftBank, Co2, Insight, KKR.
They're gone.
And they have left this region, right? And I think we saw a lot of regional funds also raise very large follow-on funds to go after opportunities beyond their kind of initial core competency of market.
Yeah.
Responding to macroeconomic conditions. And 22, 23, and with a hangover in 24, that capital, as you mentioned, has left. And I think that's made it, I think, tough in terms of the message that investors are sending entrepreneurs, which is, to some degree, if I think of it, cynically, it's, well, when we want you to grow really fast, here's a lot of money. But when we change our mind, all of the money is gone, and now you need to find a way to be sustainable by yourself. And then maybe more money will come in the future to get you to where you need to be from a capital runway perspective.
See you later.
Yeah, and that's not a healthy dynamic, right? It erodes perhaps some of that social compact between investor and founder when, as an investor on the board, there's responsibility as being part of the company to see it all the way through, thick and thin. Also, I think a lot of that sort of more transient capital was at the growth and later stage.
Yeah.
And when we think about exit markets, there's that sort of growth equity relative gap to bridge companies that have tremendous potential, but where, $200 to $300 million AUM funds may not be able to sustain all the way through to IPO. And so entrepreneurs might have to be faced with a difficult decision, which is, do I limit growth, get to sustainability faster, but have a lower ceiling on outcome, which then doesn't really perhaps drive the same virtuous cycle on returning capital for investors? Or do I take risk with the hope that Tiger is going to show up again? And all signs suggest that that may not be, a high yield strategy given where things are sitting. So it's almost like an impossible choice where both options become more challenging. And I think it's really on the investor, particularly the Series A, B investor, before you kind of get to that point where the reliance is on growth equity to kind of bridge the gap to an exit, to guide and be transparent and direct in some of the capital planning that we previously mentioned is really important, so that there is alignment for founders and they have clear guidance, which they may or may not take, but they have clear and consistent guidance on what's next, at least for 12 to 24 months. Things can, of course, change. And here I feel like my time in the US and investing in deep capital markets where perhaps the tides didn't move in and out as fast, right? Of course, there's cycles to it, but there's depth of capital at the seed, at the venture, and at the growth stage, and that has not changed. I think that those dynamics have been more stable. Were more stable when I was investing primarily in the US, meaning if you build a good business and you do it in the right way, capital will come. The best companies get funded in every cycle. I don't know if I think if I were to characterize in Southeast Asia that we're quite there yet. I think evidence would suggest that we're not.
Even if the company is a good company.
I think that if a company is a great company, they can raise and will most likely be able to raise in every cycle. And certainly I would love to fund any great company regardless of capital cycle, because that's where we're in. But them coming up to the surface and investors rewarding and respecting that, I think is something that is still not uniform in nature. And to give you an example, maybe one that is a less popular one to bring up, but the concept of a down round in Southeast Asia is still very recent.
Yes.
And there are many great companies out there that the only thing they did wrong, which is not even wrong, is raise at the highest valuation they could in 2022. That is profit maximizing at that point in time. I mean, you can argue, could they have done something different and staged it more? But that's what they did. And today that valuation is too high. Good company. And in most developed markets like the US, a down round is just a matter of course. You price it lower, you recap it. Maybe there's a pay to play, some anti-dilution kicks in. Let's move on. In Southeast Asia, I've seen kind of behavior where investors would rather back the next business at the seed stage that does exactly the same thing as this company with maybe a different founding team and just start all over rather than recap, because then that's a clean story where seed can become A, can become B and C with up rounds. I've seen it.
How's the founder going to feel?
And well, it's their competition. So I think the founder has to deal with competition everywhere. But my argument, counter argument would be, as part of this, social compact I mentioned and investor founder dynamics on follow-on capital in a market where things are slower, it's recap, down round, back the founder that you have, or back the companies that, maybe new investments for an investor, but that have already taken the hits, gotten the scars, learned from it, and have the maturity to say, yeah, we will reprice as necessary, and have the other investors in this syndicate say, yes, this is the right answer, versus let's just sunset the business, let it get to profitability, sustainability, and let's go find another company and back that. And I think that holds us back sometimes. And we feel it more for some of these growth stage businesses that didn't quite make the leap because some of the capital, the rug got pulled out from under them when some of those growth investors pulled back. So I think that's investor behavior that needs to change. And it clearly can, right? I think in other markets that has been proven to be pricing up and pricing down is just a natural part of the capital cycle.
Yeah. Okay, and the second part was on entrepreneurs.
Okay, so I'll start with the positive. I think there's much more positive than in both cases, entrepreneurs and investors over the last 8 years since I've been back. I think, as I alluded to earlier, I think entrepreneurs have their sights bigger, have higher aspirations, and have seen more of what good looks like because of the exits that we've seen. Now, that record is not as deep as we'd like, and so I'd like for that
I mean,
flywheel to
the
continue
exits
going.
haven't been that great either. I think maybe more from a symbolic perspective. I think
Indeed.
now having a couple of companies on NASDAQ is great. I guess there's something to kind of shoot for.
Indeed. Indeed. And, we spoke a little bit about this earlier, but companies being taken private, like Property Guru by EQT, are also signs.
I mean, it was a great outcome for them.
Yeah, 10% premium and was $1 billion company. I mean, that's a big outcome, even as a public company. So I think, the news in 24, I think of all of the take privates, I think that one to me as a VC investor was like, okay, this is a good thing. And that's another form of success story that I think emboldens founders and entrepreneurs to think large, right? Perhaps the areas for development and improvement, I think that, a little bit on that topic of corporate governance and board dynamics, it also falls a little bit on founders too. I think that Singaporean founders vary by the book, generally speaking. And this is a gross generalization, right? So I don't mean to make it a cultural generalization, but we have clear guidelines and rules here. And I think founders that either adopt Singapore as their home, not just where they raise money, but their, where they live or where, truly business is conducted, other than or in addition to fundraising, they take a very serious approach to corporate governance. And I really appreciate and respect that.
Yeah.
I think that that also happens in every other market in the region because founders want to do the right thing, but it's less uniform. And I think this idea of the exemplars are, companies that, maybe are family-owned conglomerates. They got there because of their political connections, the way that we handle, winning accounts or winning favor with the government. I mean, all these sorts of examples, and then ultimately holding equity all the way through versus and optimizing for the founder's goal as an owner of the business as opposed to shareholders' goals as stakeholders broadly of a business. I think some of that is quite spotty in other parts of the region. And I think there's lots of room for improvement, but I think that's why we have to keep our eyes open, why we have to have transparent dialogues, and why I think Singapore plays such an important role if we want the Southeast Asia ecosystem to keep going from strength to strength, because at the core, it is all about trust.
Yeah. I think just out of curiosity, do you still see a lot of predatory kind of behavior from investors today? I mean, I guess in the early years, I would hear, especially at the seed stage, a lot of predatory kind of investors. I mean, do you think most of it's gone now, or do you still see a lot of that happening even now?
Well, I think that there will be a spectrum of how aggressive both investors and founders can be on economic terms in any market. And I think when I think of some of the practices perhaps you're mentioning, it would be taking an unfair share of founder equity, or putting in certain protections in terms that are off market that only favor the investor in all outcomes. And I think that in the early years of a venture ecosystem starting up, VCs, that perhaps didn't manage, call it institutional capital, may also have thought of their investment portfolios kind of like a founder-owned conglomerate or mini family office, right? Where it's I own your shares in this company, therefore I'm going to dictate the terms of how those shares will be governed. And as ecosystem matures, I think the guidelines and norms move towards market standards, driven really by the West, where venture capital was started, such that that kind of predatory behavior, or behavior that perhaps is overreach in nature, starts to naturally get scaled back because the best founders don't accept those terms, and the best co-investors don't want those terms either because it creates disincentives or misaligned incentives. And so what will end up happening is the only founders or companies that take those terms are the ones that are not the best companies, and so natural selection weeds out that. And so I think that there's always room, and there will always be behavior that is overreach because greed is human nature. And there will be, I think, investors out there and founders that do things to enrich themselves at the expense of other investors and participants that they have a fiduciary responsibility over. But I think that if you have pricing transparency, market transparency, if you have standards and norms like what the SVCA does, right, on term sheets as a guideline and publishes that, and as you have good corporate governance, and as I mentioned, some of the other institutions here, particularly in Singapore, where most of the regional topcos sit, I think a lot of that perhaps bad acting or negative externalities have washed themselves out. But at the end of the day, the price mechanism solves a lot of things. And so you can have all the cleanest terms and a very, very low price. And I think an entrepreneur might still decline and rather, parlay in an environment where there's lots of structure and protections to investors that are perhaps theoretical if you're optimistic, but where they get a higher price. And so, that therein lies the art of the deal craft and negotiation. And sometimes there needs to be mutual education that takes place on, well, what if this happens? What if that happens? If everything's great, then sure, take the highest price, the least dilution. But perhaps you might want to also think if things take longer and cost more and you need to raise more money faster, or a down round scenario, then this can be really punitive. And it's not good for the founder or for the investor for that outcome to create a major distortion on the cap table. So I think we've moved past some of that stuff.
Okay, quick fire round. First question. What was your best investment decision?
Oh, well, I had the privilege of backing a company called Silver Cloud Health that is a leader in mental health treatment as well as software. And what made it a great investment was the opportunity to go and meet the founder in Ireland, help him and his team expand to the US and globally. They also have business in Southeast Asia, and see them ultimately become a very large player in their market and get acquired ultimately by American Well for $250 million. So it was a big outcome financially. But what made it I think very rewarding for me was the space it was in. I think mental health is often overlooked and stigmatized. I think Southeast Asia, the conversation is now picking up, but it took a long time to get there. And I think the company is also doing some very meaningful things. So for me, having that alignment where you have good dynamics with the founder, an opportunity to go and see something that's in a market that's not obvious, bring it into a market that is obvious but competitive, and then see it through to exit when the company is making some real meaningful changes, something that I always cherish.
When did you guys enter? Was it an early stage investment?
I invested at my prior fund at B Capital. I led the Series A in 2016, and the company exited during COVID in 2021.
Okay. Are you able to share how much you guys made?
Well, I can share that our initial check when we led the Series A was at low double digits, sub 20 pre-money.
Okay.
And our the exit of the company was at 250 million. It's a nice outcome.
Right. Oh, okay. Second question. Your worst investment decision.
Okay, so this time I won't name names, but I will characterize a couple companies, two, that share the same characteristics. And I think good fodder for learning and improvement. Both happen to also be healthcare companies. I tend to do a lot of healthcare. One was in the US in call it the healthcare data and vaccination space. The other is in Southeast Asia in the call it primary care telehealth space. And I think in both cases, I think that I tried to see something that maybe wasn't there.
I guess this happens to a lot of investors, huh?
Yeah, and where the thesis sounded great and the data points fit the thesis, but you only see, or I perhaps only saw what I wanted to see as opposed to what really was less clear. And in the case of the first one, without getting into too much detail, because I think that would kind of perhaps give it away, what they were booking as revenue in this vaccination space didn't match up with what they were really collecting because they were giving out a lot of, charitably free vaccinations or free product. And there was no business model in doing that. And I think...
How did you find out?
We found out after investing when we started seeing some of the numbers come back and reconciling performance against cash. And that's something we should have picked up beforehand.
Ooh, yeah.
Right. And what I saw was, vaccinations, important. It was pre-COVID, right? Public health, they had a public health angle, very important. while very high metrics and numbers on how many sort of services and vaccinations were being provided, and seemed like a scalable channel to do so. But double clicking further on how many of those were ultimately economically viable, I think is something that I missed. And then kind of taking that to the second company, slightly different circumstances, but also a company we invested in during COVID. Thesis was also that healthcare would move online, and I think after COVID ended and offline settings became prevalent again, not just in healthcare and e-commerce, back to mall and education, back to school, but certainly in this case, I think we were betting on a certain growth path that I don't think was actually ever going to be there, and we did the deal without having spent enough time with the founders because we did it remotely during COVID, and the founder dynamics as well as how management reacted to changing market dynamics led to misalignment and ultimately, I think, some contentiousness. Right. So I think those two. What's the key takeaway? I think got to do the homework. Don't look for something that isn't there, and spend time in person with founders so that there is a mutual understanding and baseline.
One book you think every investor should read?
Oh. Well, I think everyone should read Outlive by Peter Attia.
Okay, I have read that.
I think it's important. We talked about
You really like healthcare, huh?
earlier. Yeah, but I think health span
Yeah.
and lifespan, but wellness and longevity, these are universal themes that all of us have to think about. I spend a lot of my time in healthcare, but as a diversified fund, I look at other areas. But I think this is a core area that we need to think long term. Being an investor is about thinking long term. And investing in your health is also about investing in your future. So I think that's one. But that is more of a personal interest recommendation. One that I think I would also recommend more, perhaps linked to the business of investing. You may not expect this is my suggestion, but it's a company called it's a book called Over the Edge of the World, and it's about Magellan's circumnavigation of the globe.
Oh, interesting.
And it talks about how when he first outfitted his voyage, it was very much like a venture. He raised money from the state and from private enterprise, and he stocked it with enough food and supplies and people to go for X amount of time. He was planning to be away for a year. It turned out to be many, many, many more months than that. And he went out in search of something that was not defined at the time, which is the New World. And he wasn't actually expecting to find New World, expecting to find India, right? And the East Indies and everything that came from it. But he ended up circumnavigating, hence the title of the book, the whole world and finding a whole lot of places, including North America, that would not have been found if he didn't have that vision and there weren't people willing to take that risk. So that would be my recommendation, to keep that historical context in mind.
Okay, I'm going to add that to my list. One thing about Southeast Asia that you think is highly underrated?
The food. Well, okay. I mean, aside from that, in the business context,
really quickly.
no. I think I absolutely. I mean, being Singaporean, coming home, it is great to be back into Singapore culture, and Singapore culture equals Singapore food, amongst other things. But jokes aside, I think something about that's a bit underrated. I think first in my space, I'm always blown away by how dedicated and ambitious our entrepreneurs are. We talked a little bit about the what has changed, the good and the bad, but what has always been the case, I think, is a mindset of growth, and I think that's really important to build the region for the next phase, the next decades ahead. And I think our entrepreneurs think international, perhaps not global, but international from day one. Our entrepreneurs.
What's the difference between international and global?
A Singapore company wanting to go after Malaysia, Indonesia, or Thailand, as opposed to build enterprise software and IP to license and elicit royalties in the US. Something like that, perhaps.
Okay.
But I mean, global is global. Yeah. Global means you go up against heavyweights in developed markets. I think international could mean regional, where you're defining and carving out space immediately. I think aspirations can vary. Not every business deserves or should be a global business. That can be overreach. And not every business should be multi-market or international. But I think that growth mindset of being like someone who wants to build a business outside of their comfort zone and their immediate language and socioeconomic environment and cultural context, and compete as a Singaporean founder in Indonesia when Bahasa is their third language. I mean, that kind of gumption is unique to our region because it is multi-ethnic, fragmented, and those can be challenges. They can also be strengths. I see a lot of that strength in our entrepreneurs.
Okay, cool. And Actually, you talked a lot about this. What are you most bullish about in 2025? A lot.
Well, 2025, I think, is set up from a business and capital markets perspective to be stronger than 2022 to 2024. With regards to how sustainable that is, I think the jury is out. But what I foresee is the following. I think the global economy will be guided by U.S. economic and foreign policy. Under the current administration, we will see a more pro-US and pro-US business perspective. For the rest of the world, what that means varies depending on what you do and where you sit. But I do think that there's a silver lining for Southeast Asia from many different perspectives, and that's where my comments come from. I think that tariffs on Chinese exports will lead to Chinese companies offshoring into their nearshore, which is Southeast Asia. We already see that 8/10 of Thai industrial stock are Chinese companies and factories moving across the border to avoid the prospect of 20% tariffs. That doesn't mean that the rest of ASEAN isn't going to get hit by tariffs, but unlikely to that level. And hence, there's an arbitrage opportunity while all this happens that can lead to, I think, tailwinds for Southeast Asia business. We talked a little bit about inflation and interest rates. From a sectoral perspective, something we haven't spoken about, I think that Southeast Asia is quite well placed for a number of reasons in the following areas. I think that we are a traditional energy and fossil fuel rich region, Indonesia in particular. I think that the energy sector and conversely, perhaps not so much the sort of modern climate, but more traditional energy and fossil fuel will be less heavily regulated under a Trump administration. And so I expect that we'll see a boom. And I think that will be good for our region relative to perhaps other times in the cycle or other regions. I also think that with a Sino-US diplomatic environment that we're seeing right now, that there will be more, call it, spending overall on defense and aerospace and military industrial complex. And I think in certain areas, like we spoke about, space tech, satellite tech, communications technology, deep tech, we will see a resurgence in interest. And this is also where Singapore is well placed, being sort of not aligned, right, and not seen as an extension of kind of Chinese, call it, influence. I think another area in general, since we're touching a little bit about, on financial services, is we will see interest rates stay a little bit higher for a little bit longer. But with the downward trend that we've seen over the last 12 months. And I think this is probably good for banks. So I think bank stocks on the SGX will probably do pretty well for the dividend chasers out there. But in fintech and upstream, I do think that we sometimes have a joke that every company is a fintech company in some way, shape, or form. Even if they're not in payments or lending, they might be offering embedded financial services in a B2C or B2B way. I think those models will see more tailwinds, married with the fact that US policy has already started to scale back some of the financial industry regulations on capital requirements and capital adequacy, which, while arguably could make banks riskier, will also spur cross-border growth and M&A. And so I think these are generally pro-business. They tend to be pro-cyclical changes. Inflation cannot be high forever. It will ultimately arrest growth. But for the next 4 years, with I think a Trump-driven foreign and economic policy, just sort of constraining my comments to those areas, I do think that Southeast Asia is really very well placed. So those are the bets that we'll be placing in the year ahead.
What about in terms of consolidation? Do you expect more of that happening? Especially, I don't know in terms of the pace of these types of consolidation. Is it happening fast enough? Do you think it can go faster?
I think that we're seeing more corporate development activity from North Asia, in particular Japan and Korea, picking up assets in Southeast Asia, strategic assets, and also investing off their corporate balance sheets. So I think in the near term, yes, from those sources. We've seen a little bit less Chinese cross-border buy-side M&A, more opening up and offshoring, right?
Yeah.
Like ByteDance. So that TBD. In terms of US cross-border, coming back to my comments earlier on US foreign and economic policy being pro-US and pro-US business, I think that will provide less perhaps restrictions and more capital availability for American large enterprise to pick up assets in emerging markets, including Southeast Asia. So we haven't seen as much of it yet. Some of it's scaled back, given the global macroeconomic environment in the last few years. But I think a case could be made for why that could change going forward in a healthy way.
Okay, but all this is cross-border. What about domestic?
I think that the exits for tech companies to regional conglomerates, that record has not been particularly active in recent years. I think M&A in the local markets in Southeast Asia have been traditional conglomerate buying smaller traditional business. But that could also change over time. In terms of conglomerates buying tech companies or startups beyond acquisition of talent, but actually exits, I think there's still a multiple mismatch in terms of valuation expectations. So I don't see so much of that. I think it's probably going to be for cross-border M&A, big tech buying small tech. And in Southeast Asia, there's not so much big tech. So those buyers for regional M&A might be more like Grab consolidating, taxi fleets, right? As they've made, some
Which has happened.
recent news about. I think it got antitrusted with a little bit of back and
That's the
forth.
problem that they face, I think.
Yeah. When you become the market leader and you're too big. But I think that kind of acquisition, I can see. I can see that kind of M&A.
Okay, cool. Thank you so much. We've come to the end of the podcast.
Thank you for having me. It was a blast. Thank you, Kristie.
Thank you.